Good morning and welcome to our webinar. My name is Louise Marshall and I'm an Associate Director here at Seymour Taylor. In the next 40 minutes, we're going to look at what tax changes are planned in 2023 and beyond, and how you might prepare you and your business affairs to maximise your earnings and minimise your tax bill. If you have any questions at the end, I've allowed some time for you to answer these, so please feel free to use the Q&A function, and my colleague Suzanne will be monitoring the questions for me. So what topics would we like to cover this morning? Particularly business tax planning and personal tax planning. So in line with business tax planning, we're going to look at preparing for your year end, the corporation tax rise, R&D tax credits and capital allowances. And in terms of personal tax, we're going to look at the tax freeze and the impact of inflation, changes to dividends and the capital gains tax annual exemption. So what substantial changes are ahead for us this year? There are several significant changes to taxation close on the horizon, including an increase to the corporation tax for some companies from April 2023 with a new top-up rate of 25% top rate, reforms to the R&D tax credits aimed at tackling abuse. So this includes a reduction to the S.M.E Scheme rates, the end of the super deduction capital allowances next month, a reduction to both the dividends allowance and the capital gains tax annual exemption, the continued freeze on our personal allowances and reliefs until 2028, and don't forget the delay to the Making Tax Digital for income tax self-assessment, which has been moved back from 2024 to 2026. So it's important now more than ever to utilise all the tax reliefs and allowances available before the end of the tax year on the 5th of April 2023. In order to minimise your tax liabilities. With many changes imminent, the clock is obviously ticking. So in order for you to ensure you and your business retain more income, you need to act now. There are lots of strategies and actions that you can take place to manage your tax bill, and careful planning is needed to make sure you strike the right balance. So let's start by looking at what steps you can take this year. Firstly, business tax planning, which can be a complex area, and business owners need to consider their current position carefully before the year end, as it may be necessary to balance your own needs and desires to earn more from your business and the existing tax opportunities for the company. The areas that you might want to consider include dividend taxes, corporation tax, capital allowances, and R&D tax relief. Looking now specifically at the corporation tax, have you made use of your relief and allowances available to you? So some of these I'll cover later, such as the capital allowances and the R&D tax credits, but managing your corporation tax bill has never been more important. While the rate is currently 19%, this is going to increase from April 2023 for companies with profits of more than 50,000. To as much as 25% for businesses with profits exceeding 250,000. So businesses with these thresholds can benefit from the marginal rate relief on a taper scale to reduce the effective rate of their corporation tax. The rate of 250,000 is adjusted though if company's accounting period is more or less than a year, and also if the company is part of a group and has associates. So therefore, if a company had one subsidiary and each company made profits of 130,000, then they would both be taxed at 25% on the excess above 125,000. And the same applies with the other thresholds. Given these changes to the corporation tax, you may want to consider carrying forward losses into the new tax year to reduce your overall levels of profitability. So if you face a high rate of tax, you could, for example, increase your pension contributions or possibly fund the purchase of a company car so that your profits remain below that £50,000 threshold. You may also wish to consider whether it would still be tax efficient to run your business as a corporate body, because sometimes in certain circumstances that may not be the best scenario for you and your business now. You may want to think about things like whether your business tends to experience seasonal profits, or do you expect to realise a large gain in an accounting period that will straddle the current and next tax year? So changing your company's current year end might also allow you to manage your profitability and reduce your effective rate of tax following the corporation tax rise, And similarly, you may want to reduce your accounting period length in order to get the benefits of these. So just going to look at capital allowances now. So capital allowances can be claimed by business and companies, and they're a way of reducing your taxable profit. Capital allowances are claimed by companies in place of depreciation. It's a way of standardising the tax system. There is an enhanced relief available under the annual investment allowance regime and the super deduction regime. The annual investment allowance, also known as AIA, is a form of tax relief for businesses that is designated for the purchase of business equipment. The AIA allows a business to deduct the total amount of qualifying capital expenditure up to a certain limit from its taxable profits in a given year. You can claim AIA on most plant and machinery up to the AIA amount. If your business buys a piece of equipment that qualifies for AIA, you can deduct 100% of that cost of the asset from your business profits before you work out how much tax is due on that profit. The government sets a limit for how much AIA allowance a business can claim in a year, which means that if you buy assets costing more than the limit, you won't be able to claim the AIA on all of your assets. So the limit was previously 200,000, but in January 2019, it was temporarily increased to $1 million, but this limit has now been made permanent. So there are a few things that you cannot claim AIA on. These things include such likes of cars, items you've owned for another reason before you brought them into the business, and items that have been given to you or your business. So if you can't make a claim for any of those reasons, you can use writing down allowances instead. The next area I'm going to just touch on is the outgoing super deduction. So this was a new relief that was introduced in 2021, but will end shortly on the 31st of March 2023. So we've only got about a month to use this. This relief was only applicable to incorporated companies, and it applied from the 1st of April 2021 until the 31st of March 2023. So companies investing in qualifying new plant and machinery assets were able to claim 130% super deduction capital allowance on the qualifying plant and machinery investment, or a 50% first year allowance for qualifying special rate assets. So the super deduction will allow companies to cut their tax bill by up to 25 pence for every pound they invest. The super deduction included a new first year capital allowance for qualifying plant and machinery assets and for qualifying special rate assets. So special rate pool items are generally assets in relation to integral features in a property. So this could, for an example of this could be air conditioning or maybe hot and cold water systems. And the idea of the super deduction was to encourage companies to invest in productivity enhancing plant and machinery assets that would help them grow. So if you still plan on using this relief, you need to make the investments now. So please feel free to visit our website or contact one of us who will be able to help you on this. To give you an example of how the super deduction worked in real life, here you'll see an example. So it's a slightly exaggerated example, but should your business spend £5 million just one day apart on either the 31st of March or the 1st of April, they'd be able to take advantage of this super deduction, and it would save themselves tax and therefore cash of just over 900,000. So as you can see, it's quite a significant amount. As mentioned, firms can also benefit from the main rate pool, the special rate pool, and the structures and buildings allowance, which are all writing down allowances. So if a company is eligible to claim capital allowances on an item, they can claim these at rates of either 18% or 6% writing down allowances. And if incurring expenditure on a property, the structures and buildings allowance is currently at 3%. So I'm now going to move on to research and development claims, which is quite a big topical area at the moment. So back in April 2000, HMRC launched the R&D tax relief scheme specifically to reward UK businesses making scientific and technological developments, as it was an enhanced claim. It counted as notifiable state aid. So 20 years on from its introduction, many companies who are eligible are still failing to claim this valuable relief. R&D tax relief, or the credit, is a company tax relief that can either reduce your company's tax bill, or for some companies, it can provide you with a cash sum. R&D credits are available to all companies, small, medium, and large size entities. Depending on whether the company has taxable profits, these can result in a cash repayment for the company, which helps with cash flow, particularly when the expenditures result in a loss. This scheme has been very, very successful, but because there has been some accusations of abuse, means that the rules are being reformed from April this year. In general, to qualify for R&D, your company must be carrying out a project that seeks an advance in science or technology. There is a lot wider definition of what falls into this, so you would need to check that your project qualifies. So generally, what counts as R&D expenditure? This includes direct and externally provided staff, subcontracted R&D, consumables, software, trials, prototyping, and independent research costs, which may all qualify for R&D relief. There are some special rules regarding what staff costs can and cannot be claimed, so you'd have to check the legislation for this because it's quite specific. HMRC has two schemes available for claiming the tax relief. The small or medium-sized enterprise scheme, which is often known as the S.M.E Scheme, and there's the research and development expenditure credits, which is also known as the RDEC scheme. So to be considered for the S.M.E scheme by HMRC, your business needs to have less than 500 staff and either a turnover of under 100 million euros or a balance sheet total of under 86 million euros. And these limits apply to the whole corporate group if the company is part of one. The S.M.E R&D tax relief allows companies to deduct an extra 130% of their qualifying costs from their yearly profits, as well as the 100% deduction, so effectively a 230% reduction. So, for example, if a business spends £10,000 on qualifying R&D expenditure, within the tax computation, they'll be entitled to an additional £13,000 worth of relief, so resulting in £23,000 worth of relief in total. So if we take into account that example of £23,000, the effective rate of tax relief, because you're going to get an extra 4,370, equates to an effective relief of 43.7% on the initial qualifying expenditure. So if the company is loss making, you can also make a claim for a payable tax credit, and this is worth up to 14.5% of the surrenderable loss, which effectively results in tax relief of 33.35%. While the R&D tax credit scheme is a tax relief, its benefits are numerous. For example, the recovered funds do not have to be used in a specified way. So they can be reinvested into obviously further R&D if you so wish, or they can be used to purchase new machinery, materials, or technologies, or invested in general to help your business grow. The RDEC scheme replaced the large company scheme in April 2016. It works in a very different way to the S.M.E scheme, as the credit is entered into the financial statements of a company, so not just on the tax computation. The RDEC must be claimed by businesses that qualify as large, but in some circumstances, they'll also be able to claim, it can also be claimed by SMEs who have subcontracted work to do R&D work by a large company who have received a grant or a subsidy for their R&D project. The credit is calculated at 13% of your company's qualifying R&D expenditure, and if the expenditure was incurred on or after the 1st of April 2020 and is taxable. There are different rates that apply prior to April 2020. Depending on if your company is profit or loss making, the credit may be used to discharge the liability, or it can also result in a cash repayment. The RDEC is a tax credit, so you can claim it up to 2 years after the end of the accounting period in which it relates to. So how do you make a claim? So what you'll need to do to support your claim, as well as calculating the figures, in order to support your claim to HMRC, you need to provide them with a justification report that explains how your project meets our HMRC's definition of R&D. So just as a sort of a reminder of what actually qualifies as R&D, the project needs to have looked for an advance in science or technology aimed to achieve this advance. The project has to have overcome specific or technological uncertainty, and you need to explain how you've overcome this uncertainty. And finally, it cannot have been easily worked out by a professional in the field. So from April 2023, new rules for the R&D tax relief can come into play for businesses, and they have to submit a pre-notification of their claim to HMRC digitally. So this applies if a business is a new claimant or it has not claimed in the last 3 financial periods. The requirement to pre-notify HMRC will affect any business that conducts R&D if they are eligible to claim under either the R&D RDEC scheme or the S.M.E R&D relief scheme. The changes will predominantly affect SMEs as they're more likely to be the first-time claimants of the R&D tax relief. This is part of a wider package of reforms, which also includes R&D reliefs will be focused on the UK from the 1st of April 2023, and all subcontracted R&D and the cost of externally provided workers will be limited to work undertaken in the UK. Businesses will be able to include the costs of purchasing data for R&D projects or using cloud computerized services within their claims. Also, from the 1st of April 2023, the rates of relief offered by the R&D incentive will be changing. So the additional deduction rate for the S.M.E scheme, which was currently at 130%, is reducing down to 86%, so making a total deduction rate of 186%. So still valuable. The S.M.E credit rate is going to decrease from 14.5% to 10%. But the R&D expenditure, the RDEC rate, is going to actually increase from 13% to 20%. Importantly, if you are loss-making, you'll now only receive £18.60 per £100 spend, whereas from April next year, you could have £33.35 per £100. So profit-making SMEs will see the amount they can claim reduced in real terms by 13%. The reduction to the rates of relief available under the S.M.E scheme come at a time when obviously the corporation tax rates are rising for more profitable businesses. So therefore, it's really important to calculate the impact of these changes on your investment plans at this present time. And finally, in terms of R&D, I have put a few questions together that might help you to distinguish whether you could apply for R&D. So you need to sort of ask yourself, have you developed your own software? Have you developed internal processes that reduce costs and improve production time? Do you carry out any design work that enhances technology? Are you in the business of manufacturing products? Are you using existing technologies in a unique way? Are you combining 2 or more existing technologies in a way that has never been previously used? And do you have any pending patents for products or services that could qualify? I'm now going to cover a few other areas of business tax planning that you may want to consider. So there's a wide variety of other ways for businesses to reduce their annual tax bill while supporting their own goals, such as employee recruitment and retention, which seem quite vital at the moment too. So things you might be considering are things like salaries. So you might be considering the payment of salaries to owner managers at tax efficient levels. Benefits. There are a wide range of benefits and salary sacrifice schemes available to employees and directors, such as electric cars, charging points for electric cars, which are a key tax efficient way of remunerating key personnel, Benefits in kinds on electric cars are currently 2%, which is significantly less than a petrol or diesel vehicle. EMI share schemes, which is also known as the Enterprise Management Incentive. These are a tax-efficient way of giving shares to key staff to help retain them and sort of provide a sense of ownership. The scheme is ideal for small entrepreneurial companies that might not be able to match the salaries paid elsewhere. And expenses, have you made sure that you and your team have claimed all the eligible expenses they can for this year? Incorporation, so you may be trading as a sole trader at the moment, or a partnership or limited liability partnership. Should you be considering incorporation to a limited company? It's a way of a more tax efficient business structure and a way of remunerating yourself more tax efficiently. Profit extraction, are you making the most of the opportunities through dividends to extract profits from your company? So now I'm going to go on to personal tax planning. There are some personal tax planning points to consider that may help to reduce your tax bills. The threshold for the additional rate of income tax is going to fall from 150,000 to 125,140 in April 2023. So this is going to push thousands more people into the 45% rate of tax and the 39.35% rate of tax for dividends. Will this change affect you, and how much more tax may you have to pay in the future? Inflation is likely to drive many owners into this higher tax bracket as well for the first time ever, so planning is critical. Interspouse transfers. Have you maximised capital gains and income tax rates and allowances through exempt transfers? So for individuals whose annual income is between £100,000 to £125,000, this is an ideal way of reducing your tax liabilities. Have you thought about exchanging your salary for benefits? So you could consider exchanging part of your salary for payments into approved share schemes or additional pension contributions to take you below that 100,000 threshold. Have you thought about a company car? Is it time for a new car? Have you thought about how you could switch to an electric vehicle and maybe, reduce your benefit in kind tax that you're going to pay? Have you thought about dividends and bonuses? Consider paying these early so they fall in the current tax year. Equally, for individuals who receive low levels of income, it might be worth deferring those dividends. Is it possible to earn dividend income each? It is possible to earn dividend income each year without paying tax on them. So you might need to think about things where people have got unused personal allowances, the option of taking a dividend there to utilise that. And dividends falling within the dividend allowance are also have got a nil tax effect, the 0% banding. The current dividend allowance, where you don't have to pay any tax, is £2,000 for the current tax year. Anything in excess of the dividend allowance is taxed anywhere depending on a taxpayer's marginal rate of tax. So it can be from 8.75% up to anything to 39.35% for additional rate taxpayers. Please bear in mind, though, that the dividend allowance is going to fall to £1,000 from April, and then it's going to fall again to just £500 the year after. Directors' loans. Have you used the tax-free interest amount on any loans to your business? So depending on your income levels, this could be, you could have some marginal savings here. However, please be aware if the loan isn't repaid within 9 months, then you or your business could face a tax bill. Stamp duty land tax. So if you're looking to purchase a home or a second home in 2023, have you considered stamp duty? If you're purchasing additional property to your main home, so you're not your PPR, you may be faced with a 3% surcharge on the top of the current rates of stamp duty. The government have obviously recently announced at tail end of last year that they're going to extend the tax freeze on personal allowances up until 2028. So this means that millions of taxpayers are likely to be pushed into high rate tax bands, especially as inflation increases wages and incomes. So you can see the current rates of tax bandings on screen. So the personal tax allowance is going to stay at 12,570 till 2028. the IHT band, the same with the residence nil rate band and the annual tax-free pensions allowance. Of course, anything could change at the moment. We've got this upcoming budget, but as it stands at the moment, this is the case. Now I'm just going to touch on capital gains tax. Have you used your annual exemption for 2022-23, which is currently 12,300? The annual exemption is going to be more than half come April 2023, so it's going to go down to £6,000. And then plans are to reduce this further to £3,000 from April 2024. So this could drastically affect the disposal of assets, particularly during the sale of a business or shares or property. Capital gains tax rates are currently can range from 10% up to 28%, depending on the type of the asset and whether you're a basic or high rate taxpayer. There is a relief, business asset disposal relief. This was formerly known as entrepreneurs relief. The lifetime limit for qualifying gains has been reduced from £10 million to £1 million. So if you do qualify for business asset disposal relief, then any gains could be taxed at 10% as opposed to 18, 20 or 28%. So it's worth seeking some advice significantly before any potential disposal to discuss whether the disposal qualifies for this relief. And if not, what could be done to possibly change that situation. Equally, if the disposal would currently qualify, we don't know that it will continue to qualify with things constantly changing at the moment. Dividend taxation. So have you utilised the 0% dividend tax band at £2,000 this year? Don't forget, this is obviously reducing to £1,000 from April and £500 from the year after. Following the changes last year, the previous tax rate on dividends was 7.5% for basic rate taxpayer, but now that's currently 8.75%. And for high rate taxpayers, the rate increased from 32.5% to 33.75%. And those on the additional rate of tax, those people earning more than 150,000 at present face a even higher rate of dividends tax, which is currently 39.35%. So with the changes to the allowance and the already higher rates of dividend tax, it may be worth considering taking a slightly higher dividend this side of the new tax year before changes take place. So looking ahead, you may need to reassess how you're remunerated so that you continue to enjoy the tax efficient income from your business. Going to briefly touch on inheritance tax planning. So as well as focusing on this current year end, you might need to make sure you're putting plans in place for the future, especially if you're among the growing number of people to be affected by inheritance tax. There are some steps that you could take to minimise your IHT bill. So charitable gifting. So if you leave at least 10% of your net estate to a charity, a reduced rate of 36% rather than the current 40% IHT applies. And this could save you and your family money. You might need to consider the annual gift allowance. So you can give away a total of £3,000 worth of gifts per person each tax year without them being added to the value of your estate. This allowance can be carried over for 2 years if it's not being used. Larger gifts above this allowance will still be subject to the 7-year rule. Gifts out of income, you can also make regular gifts out of your income, which are tax-free. If they're used for normal expenditure, which could be, for example, paying for your grandchild's school fees on a regular basis, passing on your pension, you should revisit your current plans and update your will to ensure that your family receives the full benefit of any remaining pension funds. Passing on, so trusts. There are many ways that a formal trust fund can protect and maximise your family's future assets. These have, however, had a number of changes to the treatment of trust funds recently, and they're quite a complex area, and this could actually affect some people. Pensions. So no one wants to see their hard-earned pension targeted by the taxman. So you might want to consider some of the following. So protecting your pension. The lifetime allowance has changed considerably in recent years, and it currently stands at 1.073 million. Any amounts in excess of this will see very significant charges. The annual pension allowance. Have you used your full pension allowance? You can invest up to £40,000 a year into a pension tax-free. The amounts can be carried over for 3 years, so allowing you to use any unused allowance to top up your pension. So you could potentially invest up to £120,000 this tax year if you've not invested previously. If you think this may be relevant, be mindful that the end of the tax year isn't a month, so otherwise you might lose out on up to £40,000 being added to your pension fund. Stakeholder pensions. All UK residents, including children, can make annual net contributions of £2,880 per year, which is effectively £3,000, 3,600 gross. And this is regardless of whether they've had any earnings in that tax year. Pension drawdown. So if you're 55 or over, you may want to start drawing down on your pension benefits now. So from example, a personal pension such as a SIP, even if you're still working, you can take up to 25% tax-free, with the rest being taxed at your marginal rate. There are a wide range of tax-efficient investment options available to you, which could also reduce your liabilities. So are you using them? Have you considered the following? ISAs. Most people are aware of an ISA, cash and stocks, shares ISAs, but you may not be aware of the Help to Buy ISA and the Lifetime ISA and Child ISAs. Help to Buy ISAs are in place specifically to assist people in purchasing property. Lifetime ISAs can be used to purchase a first home or for later life planning. And children ISAs are an efficient way of transferring value from one generation down to the next before a child reaches the age of 18. One of the main benefits of cash ISAs and their investment-based alternatives are that you won't pay any income tax or capital gains tax on your returns. And in terms of inheritance, you can usually pass your ISA savings onto your spouse if you were to pass away through an inherited ISA allowance. Share schemes, share option schemes are typically used to incentivize employees. Share option is the right to buy a certain number of shares at a fixed price some period of time in the future within a company, and then they can keep the shares, and if the market price is higher, they can sell them at a profit. SEIS, it stands for the Seed Enterprise Investment Scheme. This targets investments for early stage companies. Those with less than 2 years trading and 25 employees are eligible. Individual investors can invest up to £100,000 in a SEIS business per tax year and claim effectively tax relief on that. And SEIS companies can accept no more than 150,000 SEIS funding in total. The other option is the EIS scheme, which is the Enterprise Investment Scheme. EIS supports sort of larger, more established businesses, those with up to 7 years worth of trading history and 250 employees. Individuals or investors can invest up to £1 million per tax year. The company can accept up to £5 million per tax year and no more than £12 million EIS funding in total. Corporate investors in EIS do not receive tax relief on their investment, though. Venture Capital Trust Investment, also known as VCTs, are investment companies that are listed on the London Stock Exchange. They're set up to invest in small UK businesses that meet certain criteria. And to encourage support for these businesses, the government offers very generous tax benefits for a VCT investment, but this is due to the high risk nature of these investments and these companies. So, are you thinking of possibly selling your business or part of your business as part of your succession plan? You need to consider both your personal and your business tax implications of the sale. The sale of shares could lead to capital gains tax when selling your business or assets, which could also lead to chargeable gains for corporation tax. Some options for succession planning are management buyout. So if you're seeking a management buyout, the structure of the transaction could have a substantial impact on how much tax each party pays. Have you considered how the new management will be remunerated? Will the sale be achieved through shares or assets? Are deal costs going to be tax deductible? Is there stamp duty due on the transfer of any sale of property? There are some reliefs, business asset disposal relief. So if you're looking to sell your business or shares in your business and this leads to a capital gain, you could be taxed at a rate of up to 20%, depending on your marginal tax rate. Business asset disposal relief, formerly obviously known as entrepreneurial relief, could reduce its rate of tax down to as little as 10%. Maybe the other option is passing the business on to your family members. So gifting a business or shares in a business to a family member is still considered a disposal for capital gains tax purposes. So depending on when you pass on after gifting the company, the value of its shares and assets could also be included in calculations for IHT. But you could take advantage of a relief known as business property relief, which can reduce the value of the business or its assets by up to 100%. So there's a lot of content there. So I'd like to now offer you an opportunity to ask me any questions if you have any on the topics that I've covered in this webinar. I don't know if Suzanne's got any that have come through.
Hi, Louise. We did have a couple of questions that came through before the webinar that people had asked. I think you did briefly touch on this earlier, but somebody did ask, is the Making Tax Digital for income tax self-assessment still going ahead from April 2024?
So it's not. At the tail end of last year, they've decided to move this back now. So it's being moved back to April 2026. The thresholds have also been changed. So it was 10K of income. It's now 50K from April 2026. But there is going to be anyone with over 30K will come into Making Tax Digital from April 2027. Obviously, this is the current plans and anything could change because with the upcoming budget and, you know, there's many years until 2026, all things could change by then as they have done in the past.
Brilliant, thank you. And another question that we had was, can I carry forward my tax-free personal allowance or capital gains tax annual exemption?
So unfortunately, both of these allowances and exemptions are a use it or lose it basis. So they have to be used in that given tax year. They can't be carried forward and used in future tax years.
Brilliant, thank you. Another question that we had was paying back business loan stated it's to be repaid with 9 months. Is this from when the loan was taken out or from the end of the year end?
So it's from the end of the company year end. So it's within 9 months of the company year end, it needs to be repaid.
Okay, that's brilliant. That's all of the questions that have come through.
Okay.
Thank you.
Thank you. Thank you, Suzanne. So as it says here, nobody wants to pay too much tax or be penalised for falling foul of new rules. So if you want to keep your affairs in order, minimise your tax liability, please speak with me. My contact details are on the slide if you have any queries. Thank you for your time today.